Trade balance is a key economic indicator that measures the difference between a country's exports and imports of goods and services over a specific period, typically a month, quarter, or year. It is a critical component of a nation's balance of payments and provides insights into its economic health and trade relationships with other countries. Key points about trade balance. 1. Calculation. Trade balance equals the value of exports minus the value of imports. If exports are greater than imports, the country has a trade surplus. If imports are greater than exports, the country has a trade deficit. If exports equal imports, the trade balance is zero, indicating balanced trade. 2. Types of trade balance. The goods trade balance includes physical goods like machinery, electronics, and agricultural products. The services trade balance includes services like tourism, financial services, and software. The overall trade balance combines both goods and services. 3. Economic implications. A trade surplus indicates strong export performance, which can boost GDP growth, may reflect competitiveness in global markets, and can lead to currency appreciation if sustained. A trade deficit may indicate strong domestic demand for foreign goods, can lead to currency depreciation if sustained, and may increase reliance on foreign borrowing to finance the deficit. 4. Factors influencing trade balance. Exchange rates play a role, as a weaker currency makes exports cheaper and imports more expensive, potentially improving the trade balance. Global demand for a country's exports can boost the trade balance, while high domestic demand for imports can worsen it. Trade policies, such as tariffs, quotas, and trade agreements, can impact trade flows. Commodity prices can significantly affect the trade balance for resource exporting countries, especially with changes in oil, gas, or mineral prices. 5. Examples. China often runs a trade surplus due to its strong manufacturing sector and export-oriented economy. The United States frequently runs a trade deficit due to high consumer demand for imported goods. Germany is known for its trade surplus, driven by exports of machinery, vehicles, and chemicals. Why trade balance matters. Economic growth is influenced as exports contribute directly to GDP, while imports subtract from it. Currency stability is affected, as persistent trade deficits or surpluses can influence exchange rates. Policy decisions are informed by trade balance data, which governments use to design trade policies, negotiate trade agreements, and manage economic stability. Investor confidence is also impacted, as investors monitor trade balances to assess a country's economic health and currency risks. Trade balance in the economic calendar. Trade balance data is typically released monthly or quarterly by national statistical agencies, such as the U.S. Census Bureau, Eurostat, and China Customs. It is often reported alongside other key indicators like exports, imports, and current account balance. Example. Calculation. If a country exports 50 billion worth of goods and services and imports 40 billion worth of goods and services, its trade balance is calculated as 50 billion minus 40 billion, resulting in a trade surplus of 10 billion.